We'll now look at using Excel to calculate the cost of capital. For bonds, it's just like we did before, but remember there's two things we need to worry about or take into consideration. We don't need to worry so much. We take into consideration that there's a flotation cost. We got to pay the investment banker something, and the fact that interest payments are tax deductible. So let's take a look at this. In gold here, I have the parameters that were given by the example that was shown in the slide. I've changed it just a little bit because this is the way you might see the problem. We start with a par value bond of $1,000. Okay, bonds have three attributes. They have the par value, an interest rate, and a maturity. But we, the company, don't get the par value. We only get the par value minus the stuff that the stinking investment bankers are taking. So they might be taking 4.5%. Sometimes you'll actually hear it as a percent, and you're going to need to calculate that. So you can calculate the flotation cost. In this case, they're taking $45 or 4.5%. The bonds that we issue, we need to pay 5%. In the slides, I showed $50, but that's 5%. And again, this is how you might see the problem stated. 10-year maturity to the bond, and we have a corporate tax rate of $35. Okay, now what? Well, let's calculate what our cost of capital is. And we start out by calculating our rate. Just like we're calculating the rate to maturity. Oh, another thing you'll notice is that for each of these, I have named the cells. So you don't see a B4 here, you see maturity. Again, it's easier for you to understand, easier for somebody else if they have to deal with your spreadsheet. Payments. Payments are money we take out, so we're going to make that a negative number. Remember, one of the biggest problems you're going to see in rates is sometimes you'll see that $ num thing. That error is because you're probably missing a negative number someplace. It may also be that it can't calculate, in which case you're going to have to look here at the guess. You might have to guess that it's 10% or 20% or something like that. But the biggest problem will be a positive or negative number missing. So what am I paying out? Well, I'm paying out those interest payments, which are equal to $1,000 times the interest rate. That's the interest payments, and it's a negative number. What's the present value? Well, the present value is what I'm getting. I'm getting my par value, except for, again, those stinking investment bankers are taking out $45 in flotation costs. And I need to subtract that. My future value, so by the way, so notice this is a positive number. I'm getting this. My future value, unfortunately, is a negative par value. I have to pay that out. All right, so I'm going to calculate the rate just like I was doing a yield to maturity, although I'm doing it from the viewpoint of the business. If I was doing it from the viewpoint of the investor, I'd switch the positive and negatives around. And what do we get? 6%, or if we add another decimal point, 5.6%. But that's not our cost of capital. What do we need to do? What's missing? Well, our cost of capital is actually equal to that amount times 1 minus the tax rate. And that's our cost of capital. Oh my goodness. Let me move this down. Let me take this so you can see the All right. And there you go. All right, so that's calculating the cost of capital for a bond. Things to notice one more time. In terms of when you're doing this calculation, the present value is the net proceeds. You might be told the net proceeds. You might have to calculate the net proceeds. Over here, the par value minus the flotation cost. You might have to calculate those things. It might be a percent of the par value. It might be a dollar amount. But what you put in here is the net proceeds. Don't forget negative numbers. And this one's a positive number. And then the second step is to take it 1 minus the tax rate to get your cost of capital.